The objective of this fund is to generate long-term equity compounding with a careful calibration of volatility and risk. And we intend to achieve that by combining 4 uncorrelated strategies in the fund, namely long equity, short equity, debt and call writing, and combining them in a risk-aware and counter-cyclical manner enables us to achieve this dual objective of equity compounding and calibrated risk. I will now take you through the asset allocation plan of the fund. The net equity allocation of the fund, which is long minus short, will move in a 50 to 80% range, and it will move in a counter-cyclical manner based upon market valuations and expectations. Within this, the long portfolio will range from 60 to 90%, the short portfolio will range from 0 to minus 25, and debt portfolio will range from 0 to 20. I will now talk to you about the individual strategies of the fund. We begin with debt. When valuations are expensive and our model indicates that there is a risk in the equity markets, the fund will reallocate from equity to debt to bring down risk. Within debt, our preference is for higher quality paper, so dilution is capped at 20% and the duration of the debt portfolio will range between 1 to 4 years. I will now talk to you about the equity strategies of the fund, right? Namely the long and short equity strategy, which are independently managed. The long strategy, here the focus is on conservative risk calibrated compounding, which is enabled by steady earnings growth and attractive valuations. The fund has built a number of screens to filter out companies with high risk across multiple dimensions of risk. The 3 key dimensions we look at are: first, earnings risk, where we look at the ROCE and debt to EBITDA of companies. Second is historical volatility, and third is expectations risk. Within expectations risk, the idea is to eliminate companies where the market has euphoric expectations on either growth or margins, or companies where the market expects long periods of supernormal growth. Both of these are risks that we need to guard the portfolio from. After screening out companies with these risk parameters, we build a short list. From that short list, we build a 30 to 40 stock portfolio based upon our fair valuation view. The idea is to build a portfolio with steady, granular earnings growth and a healthy conversion of those earnings into cash. Now, as an SIF fund, we have the flexibility to write call options on our portfolio holdings, and we intend to do that in periods when markets are expensive and volatility is trending upwards. So this allows us to generate yield for the portfolio in periods when markets are range bound or markets are falling, right? So together, by combining a risk first long portfolio and an ability to write call options on those holdings, allows us to reduce the volatility and risk of the strategy and generate a healthy Sharpe. Now we move to the short strategy of the fund. Our study shows that over long periods of time, we have seen that Indian markets exhibit signs of expectations exuberance. Every year, from the start of the year to the end of the year, there is a pattern of expectations getting cut. and the short strategy is built to take advantage of that. In this strategy, our goal is to short companies where estimates are elevated and are likely to get cut, and the valuations on those high estimates are also elevated. So these are the 4 building blocks of the strategy which enables us to take advantage of the various phases that a market goes through. And in this fund, we will take advantage of that while ensuring that the risk of the fund is carefully controlled and calibrated. Thank you.
Investments in Specialised Investment Fund involves relatively higher risk, including potential loss of capital, liquidity risk and market volatility. Please read all investment strategy related documents carefully before making the investment decision.